Can ETH double or triple from here? Or have we seen most of its gains for this bull market? I'm sure many of you have been wondering the same, and it's what I'll be addressing today. So, by the end of this video, you will know exactly why ETH has value and where we could see the price going. So, don't miss a thing.
Oh, hey, great to see you all, and welcome to the Coin Bureau Cosmos. Here on Earth, my name is Guy, and I am the Executive Director of Peace, Love and Understanding around these parts, yeah? Cool. Now, in my travels across the universe, I've been many things. A spirit guide, a teacher, elder of alien tribes, child of Aquarius, and Grand High Cryptopian of the planet they call Earth, yeah? But one thing I'm not and never have been is a financial advisor. No way, man. That's way too square and heavy for me. It's totally unchilled. So this video is for, the purposes of entertainment and enlightenment, yeah? Because free your minds, brothers and sisters. Now, if you want to join our community here, then engage holistically with that subscribe button and ritualistically ring that bell too. Also, know that I hold ETH as part of my personal portfolio because openness is key, yeah? Far out. Okay, let's see what's been happening and going down out in the ether, yeah? Cool.
Let's start off with one of the most contentious points about Ethereum, and that is the fees on the network. Now, whenever I read comments from people on YouTube and Twitter, the main gripe they have with ETH is the sometimes exorbitant fees. Now, I can't deny that. They are high, and these fees are a reason as to why so many people are looking for competing Layer 1 blockchains. But the more important question that needs to be answered here is why? It's not as if the network has fundamentally changed. There have been no changes that have made it slower than it once was. In fact, you can say the exact opposite. Due to all the Layer 2 solutions that have been developed, some pressure is being alleviated from the main chain. However, the real reason that fees are so high is because of the intense competition for block space. Competition to use Ethereum for a whole swathe of different use cases. This demand naturally has to be paid for with gas, which of course increases the cost of the transaction. It seems that those who are using the Ethereum network see the high gas fees as a cost of doing so. This is despite the fact that there are a number of other smart contract blockchains out there that people can use. It's a hard circle to square. Now, I'm not trying to say that high fees are good. I'm just trying to illustrate that there is massive demand to use Ethereum despite its high cost of usage. Now, for those of you who've watched my previous videos on ETH valuation, you'll have heard me talk at length about value capture at the base layer. For a smart contract blockchain like Ethereum, the more demand there is to use the network, the more valuable the network is as a whole. For example, as a benchmark, for the past few months, the total network fees on the Ethereum network have been almost twice those of the Bitcoin network. The numbers appear even more stark when we dive into those miner revenues. According to this analysis from Onchain Research, over 50% of ETH miners' revenue comes from fees, whereas only 1% is from fees for Bitcoin miners. Now, I must of course stress that the two have different use cases. Bitcoin has less transactional and computational demand, mainly because it's viewed as a store of value that's hodled. But if you were to view this from a pure utility standpoint, ETH is unrivaled in the crypto space. And that is thanks to two very powerful forces at the moment. Those are DeFi and NFTs. DeFi demand for ETH is at record highs. According to data from DeFi Llama, the total value locked in smart contracts on Ethereum is at $183 billion. There are hundreds, nay thousands of dApps that are being built on the protocol to be used in the burgeoning space that is decentralized finance. A space that is no longer being occupied by hobby yield farmers and DeFi degens. It's got some serious capital from VC funds, whales, and other financial institutions. The only other blockchain that comes close in terms of TVL is Solana, and even then it has less than 10 times the total value locked that Ethereum does. This is even excluding the TVL that's being locked in Ethereum Layer 2 solutions. These include the likes of Polygon and Arbitrum, which have over 7 billion in TVL between them. And by the way, if you guys are interested in learning how to use these Layer 2 blockchains, then feel free to watch my video on it. It's in the top right. Now, anywho, DeFi is not the only use case that's competing for that Ethereum block space. We also cannot forget that exploding demand for stablecoin settlement. Now, while stablecoins such as Tether and USDC are issuing on other blockchains as well, the bulk of their outstanding supply has been issued on Ethereum. But right now, it's neither DeFi nor stablecoins that's driving ETH demand to the moon. It's all about those NFTs. Yep, the non-fungible token craze is upon us, and it's not showing any signs of slowing down yet. This is because they are bringing a whole class of users to Ethereum that otherwise would not have been interested in crypto. Sports fans, music fans, collectors, gamers. According to stats from DappRadar, the floor market cap for the top 100 Ethereum NFT collections and NBA Top Shot was measured at $16.72 billion. This is an 18% increase from the month before. You can also check out the total transactional volume that's taking place on the premier NFT marketplace, OpenSea. While volumes have cooled off a bit since the August highs, we are still averaging about $46 million a day in trading volume. Now, of course, all this NFT demand means demand to use the underlying blockchains on which they're issued. In this case, it is predominantly Ethereum. Most of the most valuable collections as well as popular marketplaces run on Ethereum or use an Ethereum Layer 2. Users have no issue shelling out thousands of dollars to breach gas walls in some of the most popular drops. And all this is before we even get onto the potential for the upcoming metaverse. NFTs could become the assets in this ecosystem that is powered by a currency like ETH. It's pretty crazy indeed. But okay, let's not get too carried away here. The main point I've been trying to illustrate is the fact that ETH utility demand is sky high. Yes, it's frustrating as hell for fees, but it's not as if nothing is being done about that, and I'll come back to this point in a bit. Now, so far, I've just been talking about utility demand on Ethereum, but that's only one side of the price equation. We need to take a look at what is happening to supply. One of the biggest Ethereum updates to date was, of course, EIP 1559, which took place in the London hard fork back in August. I've covered this ad nauseum on the channel, so feel free to view some of my previous videos on it for a deeper dive. One of the main things that everyone was so excited about with these updates was, of course, the fee burn mechanism. Basically, every single fee that's paid for transactions has what is called a base fee that is burned from supply. This reduction in supply offsets some of the ETH emission that comes from those block rewards. Essentially, it reduces the inflation rate. Now, in the weeks that immediately followed the upgrade, the annualized inflation rate on ETH fell from 4.2% to almost 2%. This essentially cut emissions by half, which would roughly be akin to a Bitcoin halving event, generally viewed as a price-positive occurrence for Bitcoin. However, it was what happened in the past 2 months that I really wasn't expecting, and that was for the ETH burn rate to exceed the ETH emission. That would technically mean that ETH had become deflationary, as net ETH issuance was negative. We started seeing examples of this daily deflation happening about a month ago. And then, over a week ago, we had our first consecutive weeks of deflationary ETH issuance. But what this shows is that not only is ETH in such high demand due to network use, but it's also becoming a rarer asset. Either that's through a fall in the rate of emission or, as appears to be happening, through a reduction of the outstanding supply itself. Now do you see why ETH is sometimes referred to as ultrasound money? And speaking of which, if you want to watch these burn dynamics live, then I encourage you to check out the ultrasound.money website. It's really impressive. Not only can you see the burn rates, but you can also get a high-level overview of where the burn is coming from and how it could look after the ETH 2.0 merge. I also found this interactive graph over here pretty slick. You can tweak the staking amount, merge date, and burn rate to project future supply. So, go ahead and watch the burn. It's pretty lit. Now, of course, this burn rate is nothing compared with how things are likely to be when we reach that pivotal moment next year, the hotly anticipated proof of stake merge. For those who don't know what this is, it's when Ethereum's proof of work, main chain, and proof of stake, beacon chain, blockchains will merge. This was the second step, called Phase 1, in the roadmap to Ethereum 2.0. It will officially see Ethereum transition to a proof of stake blockchain, which will bring all the benefits we've been dying for: speed, low fees, scalability, and decentralization. This will help to not only make Ethereum a lot more usable, but it will also ease some of the criticisms that are often leveled at it. It could legitimately supercharge use of the network and allow dApps to be scalable enough to effectively challenge many services provided by traditional finance. But not only this. The impact this is likely to have on supply is profound. You see, post the merge, ETH issuance will go through what is termed the, quote, triple halvening. This is where block rewards will be cut by a factor of about 8. So, in other words, the equivalent of 3 halving events. For example, today we have an issuance of about 13.5k ETH per day. However, post-merge, this is going to drop to about 1.6k. Just think about that. Think about the hype that's usually attached to a Bitcoin halving and consider that ETH is going to go through a supply shock that is equivalent to at least 3 times that. And that's not even taking into account the fee burns. If issuance drops by a factor of 8 and fee burns remain at the same level, then the deflation gets supercharged. A net 8k ETH being burned every day. You can actually play around with these metrics using the same ultrasound money website I mentioned earlier. Now, in terms of progress to the merge, the beacon chain just went through a pretty big update recently. That was the Altair update, which took place on the 27th of October and prepared the beacon chain for the merge. Some of the most important changes were light client support, patches to incentives, increases in validator slashing, and a few other tweaks to validator rewards. Now, I've linked to the full update below should you want to give it a gander. So with Altair out of the way, everyone has their eyes set on the merge. In terms of timeline, the earliest that this could happen is February of next year. This is according to a recent ETH Dev livestream summarized by Ethereum core developer Tim Bako over here. I am really looking forward to it, as it could finally turn Ethereum into that global decentralized supercomputer it was talked up to be. And given some of the latest on-chain statistics, it seems as if everyone else is too. For those of you who are regulars on the channel, you'll know that I'm a fan of Onchain Indicators. They are a really effective way to get a sense of what other holders are doing and where value is flowing. Now, one of the first things I wanted to show you is what we see happening over on the exchange wallets. This is the total ETH that's held by exchanges in both their hot and cold wallets. As you can see, since September of last year, this has been on a sustained downtrend. We went from over 22 million ETH on exchanges to almost 14 million today. In fact, the exchange balance is actually at levels we've not seen since December of 2018. So, why is this important? Well, less ETH on exchanges means that there is less ETH available to buy or sell. Therefore, simple supply and demand on the exchange order book should dictate that this is price positive. Okay, so that's exchange balances. But it would also be great to see where these funds are flowing to. Well, one of the biggest recipients is DeFi smart contracts. That can be seen by the balance in smart contracts over here. As you can see, we are at all-time highs with over 27.5% of the supply stored in these smart contracts. So, why is this important? Well, these are funds that are less likely to be withdrawn and sold. Those who own them have them locked in these protocols because of the yield that they're earning over here. Therefore, you have less ETH that is likely to make its way back onto those exchanges. But it's not only that. You have to take a look into which smart contracts people are staking their ETH. That's because over 8 million ETH is currently locked in the Ethereum 2.0 staking contract. This is perhaps one of the most binding smart contracts around, as there is no way to liquidate your holdings until after the merge has happened. But even then, I happen to think that when the merge comes around, we're likely to see a flood of more ETH heading into the staking contracts. This is because, compared with other cryptocurrencies, Ethereum has a much lower percentage of ETH being staked. Currently, there is only about 7% in the staking contract. That compares with 77% for Solana, 56% for Polkadot, and 62% for Avalanche. Once the merge rolls around, more network participants are likely to want to start staking. Why wouldn't they? There'll be a load of fees to be earned, which will give hodlers some juicy passive income. And not only that, but given that they know how long it's likely to be locked up for, you won't have as many holdouts as you do now. Can you just imagine how rare ETH could become if roughly 50% of the outstanding supply was locked in the staking contract? Add to that the ongoing deflation, and you have a cryptocurrency that's rarer than rocking horse. Okay, so that's ETH's on-chain analysis. I have a complete video about using these tools, which is linked to in the top right, so feel free to come back and watch that later. Moving on though, there's one driver that I think is going to dominate ETH demand next year, and that is investor demand. Allow me to explain. Whereas utility demand is driven by people who want to use the network, investment demand is coming from those who want to hodl ETH for long-term gains. It's no secret that institutions are now actively allocating parts of their portfolios towards ETH. For example, about a month ago, a JP Morgan investor note pointed out that Ethereum futures demand on the CME was stronger than that of Bitcoin. This was because of the healthy contango that was developing between spot and futures prices. More recently, though, JP Morgan has come out and said that Ethereum is likely to be a better bet than Bitcoin in a high-rates environment. According to its global market strategist, rising interest rates could pose a problem for Bitcoin, as they have traditionally done for gold. However, he said, quote, "With Ethereum deriving its value from its applications, ranging from DeFi to gaming to NFTs and stablecoins, it appears less susceptible than Bitcoin to higher real yields." He also mentioned the fact that investors' focus on ESG concerns could push them away from cryptocurrencies that rely on proof-of-work mining. This is something I covered in my recent video on ESG, which is linked to in the top right. The TLDR here is that these investors may have mandates to only invest in cryptocurrencies that could be considered friendly to the environment. Once Ethereum transitions to proof-of-stake, node operation will require a fraction of the energy that's used currently to mine ETH with GPUs. Another potential driver of ETH investment demand could be coming from an ETH ETF instrument in the US. About a month ago, we saw all the hype that this brought to the Bitcoin markets when the SEC approved a number of Bitcoin instruments. Now, according to analysts from Bloomberg, they think that an ETH futures ETF could come before a Bitcoin spot one. This could come as early as Q1 of 2022, almost about the time that we could see that proof-of-stake merge. Of course, I should caveat that futures-backed ETFs are not the real deal, as they won't hold physical ETH. However, given the awareness and hype that was created around the Bitcoin futures ETFs, you can also expect a rally in response to it. Moreover, if spot Bitcoin ETFs are to come sometime next year, then it's only a matter of time until they launch an ETH variant. We actually already have a few spot-backed ETF instruments trading in Canada. Okay, so this is all fine and dandy, but I know what most of you are thinking. When moon? Well, let's take a look at some price projections, shall we? The first one that I want to bring to your attention is a note from a managing director in Goldman Sachs' Interest Rate Strategies division. He makes the case for ETH hitting 8K before the end of the year, and he does this by analysing its performance in relation to forward inflation rates. Over here on the chart, in the red line, you have the 2-year inflation swap 2 years in the future. Essentially, the break-even rate of 2-year inflation expected in 2 years. Then in blue, you have the log price of ETH. As you can see, it has tracked the forward inflation swap rate pretty effectively over the past 2 years. Of course, correlation does not imply causation, but one cannot deny that inflation has been a big factor in the demand for an asset like ETH. According to the analyst, quote, "The latest spike in inflation break-evens suggests upside risk if the leading relationship of recent episodes was to hold." Grey circles below. He then goes on to explain how the recent breakout of ETH into a narrowing wedge could be, quote, "either a sign of exhaustion and peaking, or a starting point of an accelerating rally upon a break higher. As it has become increasingly evident, it seems the latter is the most likely scenario. And if that is the case, the analyst has a target of 8K by December. Now, there are, of course, a few caveats to this, and I've linked to the article below with the full analysis for your perusal. Okay, so that's a price projection for December of this year. But what about beyond that? What about post the merge in February next year? Well, I'd like to draw your attention to this incredible fundamental analysis by Nilo Orlandi in the Bankless newsletter. It takes a look at the inelastic market hypothesis and applies it to the ETH market. More specifically, how the market could react inelastically to incoming investor flows. How these potential flows could multiply the market cap and value in a disproportionate way. Now, I don't have the time to go into it all here as it's pretty involved, but I have linked to it below. The TLDR is that the supply shock that comes from the merge could make the market even more inelastic. As more and more demand flows into ETH, we could see a massive increase in its market cap and hence price. Taking a look at his calculations, if we were to assume a 90% issuance drop post-merge, combination of the triple halving and fee burns, as well as a constant $27 million flowing into the markets per day, the price of Ether could be sustained at $20,000. Now, of course, I should point out that the author doesn't see this as the immediate impact of the merge. He thinks there could be a sell the news event which could drive ETH down by 20 to 30%. However, over the long term, the price should stabilize at $20,000. Not unrealistic at all. That's it for most of my ETH video, but a few final thoughts from yours truly. Now, I know that there are a lot of people out there that have an intense dislike for ETH. Either that or it's a love-hate relationship. Now, I suppose most of that comes down to the high costs of using the network, and I can't blame them. You want to use crypto as it was intended, but you don't want to shell out $100 for a transaction. But in a way, Ethereum is a victim of its own success. It has these high fees because of this insane utility demand. A demand that appears as if it's only just ramping up. This demand is happening at a time when ETH inflation is severely curtailed, or on some days, eliminated. A deflationary scenario that no one had predicted to occur so early. And things are about to get a whole lot more exciting when that almighty merge rolls around next year. A triple halving event that could see ETH emission fall off a cliff, while more market participants scramble to pick up this already rare asset. It's for this reason that institutions and whales have been accumulating, and why analysts are particularly bullish. Now, of course, nothing in life is guaranteed. This is crypto after all, and there are risks. There is a chance that the merge could be pushed back, as has often been the case. Let's not forget that a proof-of-stake upgrade was originally envisioned back in 2017. Moreover, we can't dismiss the technical complication that comes from upgrading a $563 billion network like Ethereum to a completely different consensus mechanism. Things can go wrong, and there won't be any second chances. On top of this, we also cannot forget that although Ethereum is the predominant smart contract chain right now, there are competing ecosystems that are nipping at its heels. These include the likes of Solana, Polkadot, Avalanche, and Cardano, to name but a few. Each of them offers alternatives to Ethereum's high-fee environment. So, you need to take these risks into account. Plug them into your personal financial model and weigh these up with the upside potential of ETH in the next 6 months, 1 year, 2 years, etc. That's a sound approach, or should I say, ultra-sound. And now I leave the floor to you. So, are you guys also bullish on ETH? Or are the fees just too much of a killer for you? Price predictions, anyone? I'd love to know in the comments below. And while you're down there, you absolutely have to check out my socials page. This has links to all the other places that you can follow me off the tube. Most of these have blue ticks, and they include my Telegram channel where I share market news and analysis, Twitter where I share updates and the occasional shitpost, Instagram and TikTok for behind-the-scenes views and memes, and of course my email newsletter where I share a breakdown of my personal portfolio as well as a breakdown of some upcoming videos. All of which you shall seek is there at the tippy top of that description box. And finally, if you found this video fire, then fire up the likes. Don't forget to subscribe to make sure you're in line to receive my latest crypto vibes. Oh, and hit that bell as well. Get these while they're hot. That's it for today, my fellow crypto fans. Guys, gotta fly.